Okay, so here's the risk management class. Today we're going to be understanding what keeps traders alive, right? We got to learn risk management so that we can keep our capital safe, right? Protecting capital is our priority when it comes to trading. Without risk management, you will eventually blow up your accounts. You will lose your accounts, right? Because you need to be able to manage how much you're risking. You need to have a clear idea of, okay, what can this trade make me? Right? What is my win percentage? All these things like that, because trading is a game of probabilities. When it comes to how much you should risk per trade, people like to say 0.5% to 1% risk per trade. But the way I like to explain it is that you have to look at it as how many attempts do I have until this account is gone. Okay. For example, if you have a 50K profit from account with $2,000 of drawdown, you got to break that up into what? 5 trade attempts, 7 trade attempts, 10 trade attempts, right? These attempts, meaning that every time you take a trade, you're risking the same amount of money. You have 5, 7, 10 times, 10 losses in a row. And that's the thing. The beauty of it is it has to happen in a row for you to even lose your account, right? It takes away the money part of it. You don't have to be looking at how much you're risking, right? You just break it up into your attempts. You have these many attempts and make sure you're risking the same amount, obviously, but you're not really paying too much about that. It's not like you're seeing a setup and you're like, oh, I'm going to risk 1,000 on this. No, you're seeing every setup you take, you're going to take it with the same amount of conviction, right? That's what I like to say. Your conviction is important. You need to be taking A+ setups. You need to be taking setups that are following your system to a T. And that way you're able to risk the same amount on every single trade. You shouldn't be fluctuating how much you're risking per trade, right? Unless it's part of your system, unless you've back tested it and it's something that can yield great results, which 9 times out of 10, I wouldn't say it is, right? Risking the same amount is the best bet, right? It stops you from taking lower value setups. And then risk to reward, something you probably heard around a lot. People like to say 1 to 2, 1 to 3, but risk to reward matters when it comes into when it plays a part in your win rate. Okay, that's where it really shines, right? So the higher your win rate, the lower your risk to reward tends to be. The lower your win rate, then the higher people like to have risk to rewards, and that's what it takes to be profitable. Like, right, if you're not winning a lot, when you do win, you need to make a lot, right? But then if you're winning a lot, then you don't need to make that much because then obviously you're winning more often and that stacks, right? And that is what I prefer. If you want to ask me what I prefer, that is it. Because those wins do something good for your psychology as well, right? Being able to win more times than you lose is great for a trader, especially when you're starting out. So looking for those 1 to 13s, 1 to 15 risk to rewards is not ideal, right? You want to stay within 1 to 2s, 1 to 1.5 even, right? And just make sure you're winning as much as you can, right? Make sure your system is back tested to have a high win rate like the one I'm going to show you. And just like that, you're well on your way to becoming profitable. When it comes to position sizing and being able to actually manage how much you're risking per trade, being able to actually know how many trade attempts you're going to have on your account, my best bet is for you to search up a position size tool for whatever market you're trading, Forex, futures, commodities, whatever it is. Search it up, be able to manage your risk and know how much you are trading. So for example, like I said, on that $2,000 account, let's say you have 10 attempts, right? Okay, that means you're risking $200 per trade, right? So you want to make sure your position tool is calculating you risking $200 per trade, right? Whatever market that is. You got to understand that your account size is going to play a role into that as well, right? So you're just going to do your math, make sure you know how much those numbers are supposed to be, punch that into that calculator, get your risk lot sizes, your contract sizes, whatever, and use that in accordance to every single trade you take, right? Not as in like, if it says 5, use 5 contracts for every trade. No, you're going to calculate your stuff every time you take a trade, right? To make sure that whatever pip amount, whatever points amount, whatever your discrepancy is for your stop loss, for example, let me draw one up for you. Right here, we have a 1-to-1, right? And as you can see right here, we have a 100. Let's look for this right here. So right now it's like a 55-point stop, right? So 55-point stop, we want to be able to calculate this into our position size calculator. You can just search up any one, right? And within 55 points, you want to be risking $200 on that $2,000 account, right? So they'll give you a number. You'll throw that number in when it's time for you to take a trade. And just like that, you'll always be risking $200 every time you take a trade. And that's going to give you that 10 trade attempts that we need when it comes to taking our trades, okay? A lot of beginners and a lot of people fail when it comes to trading because they oversize, they over leverage, they try to get rich quick. And they're emotionally trading, especially revenge trading, right? So assuming you take a loss, People love to get back in the market trying to make their money back. That's the worst way to think about it. And then they couple that with oversizing. So imagine you take a $200 loss and now you want your money back. So now you bump up your risk size and now you take a trade for 600. Like you're risking 600 now. And now you take that loss. Now you've lost 800 on your account in total when you could have just walked away from a $200 loss, came back the next day, know that you have a high win rate system. Your chances of winning is very high. Take the next trade, win that next trade, make back a positive R and be positive, right? So you have to be able to control your emotions, couple that with managing your risk, and you're already on your way, right? So those two things are very, very important. You got to understand some golden rules, okay? So survival is your goal when it comes to trading. You need to be able to live to trade another day, right? Small, consistent gains are eventually going to compound, and one trade should never damage your account. So one trade shouldn't blow your account. You shouldn't be full porting unless like you actually know what you're doing. And I don't even want to say that because that might incite you to feel like you know what you're doing. But what that is like, let's say you're trying to pass an account and whatever those are like methods for doing that, that's the only acceptable time to do that, right? Just like time reasons. But when you're actively trading an account, an XFA, a funded account, your live account, you shouldn't be full porting anything, right? Because you're here to play the game, right? You're here to be profitable, right? You're here to make money with this. And the way you're going to do that is by living to trade another day. That's literally it. Okay. So yeah, make sure you have your trade attempts down. Make sure you're using that position size calculator. Make sure you're protecting your capital. That's very, very, very important when it comes to trading. And yeah, so let's go ahead and hop into our next part, which is going to be trading with confluences.